Now, with instant reaction to the numbers is Jill Maladrino, my colleague in New York. Hello, Jill. Good to see you again. Are the earnings coming in now?
Yes, they are coming. They are coming in now. S&P futures are relatively flat, on, looking to go into the open, following a record close on the Dow Jones Industrial Average. And as big banks have been reporting throughout the morning, I want to give you some quick details on that as they come in. Citi, JP Morgan, Wells Fargo, they all beat on the top and bottom lines, although they traded lower following the announcement due to lighter trading volumes, a decline in net interest margin, despite interest rate hikes that we got twice in 2017. Recall expectations were super high going into these earnings reports, and while the banks beat, the results were not impressive enough relative to the run-up into earnings. In addition to earnings, the lack of volatility has also been a big topic for traders this week.
Now, where is the volatility coming from? Are investors simply complacent here?
I have some pretty good stats for you, courtesy of Brian Dietrich at LPL Financial. He points out that a year ago, Tuesday, marked the first new all-time closing high for the S&P 500 index in nearly 14 months. Since then, the S&P has made 42 new highs and is up 14% over the past year. Now, this amazing performance over the past 12 months doesn't stop. The index has not pulled back at least 5% on a closing basis over that period. We've got over 14 months without a correction. This is only the sixth time since 1950 that the S&P has made it at least a year without so much as a 5% correction. It marks the longest streak since 1995. So think of it like this. On Wednesday, the VIX closed at 10.3, marking the 45th time this year that the VIX closed between 10 and 11. This is already a record, topping the 32 times it closed in the 10s in 2006. So there's a long way to go in 2017, and we believe that wouldn't be surprised to see if we see some volatility into the second half of the year coming off these historically low levels.
Well, the second half of the year has just begun, so we will watch and see what it holds for the market. But tell me, Jill, what's on tap for traders next week?
Well, the focus will continue to be on Washington, D.C. The health care bill was released last night. Trump is tweeting this morning that he is ready, pen in hand, to sign it. I'm not sure if he's actually read the document, so we'll be looking at that. We also have the Russian overhang that's going to continue to make headlines. It almost seems as if the market is immune to day-to-day headlines. We'll also have a solid lineup of earnings on the calendar, including Netflix on Monday. We have Bank of America, Goldman Sachs, IBM, Microsoft, and to close out the week, the major conglomerates, GE and Honeywell on Friday.
Right, thank you very much, Jill. Do enjoy the rest of the day and, of course, the weekend.
Thank you.
We move on now to Asia, where markets closed to mostly higher on Friday trade as investors digested the second day of Federal Reserve Chair Janet Yellen's testimony ahead of earnings season. Japan's Nikkei 225 gained 0.09%. The Kospi advanced 0.21%, making gains for a second straight day after closing at a record level in the last session. Australia's ASX 200 rose 0.49%. Greater China markets were a mixed picture. Hong Kong's Hang Seng Index edged up 0.16% to hold near two-year highs. Mainland markets recorded declines. The Shanghai Composite rose 0.13% and the Shenzhen Composite shed 0.40%. And to global markets now, oil markets dipped on Friday, pulled down by high fuel inventories and improving industry efficiency, but we're still on track for a solid weekly gain. Brent crude futures, the international benchmark for oil prices, were down 7 cents at $48.35 per barrel, but up 3.5% for the week. U.S. West Texas Intermediate crude futures were at $45.97 per barrel, down 11 cents, but up around 4% over the week. Crude prices are around levels in late November last year, when a group of oil producers, including Russia and the Organization of the Petroleum Exporting Countries, pledged to withhold around 1.8 million barrels per day of output between January this year and March 2018 to tighten the market. And the precious metals now, gold prices were largely unchanged on Friday as the dollar steadied ahead of key U.S. economic data, but the metal remained on course for its first weekly gain in 3. Spot gold was nearly flat at $1,216 per ounce, but is up 0.3% for the week so far. U.S. gold futures for August delivery fell 0.14% to $1,215 per ounce. A stronger greenback would weigh on gold, making the dollar-priced commodity more expensive for investors holding other currencies. And away from the markets, Barclays Africa has launched a court challenge to the anti-graft watchdog's findings that the lender's South African unit unduly benefited from an apartheid-era bailout. Public prosecutor said last month her investigation had found the apartheid government and central bank breached the constitution by supplying a bank later acquired by Absa, the retail banking unit of Barclays Africa, with a series of bailouts from 1986 to 1995. The constitutionally mandated anti-corruption agency says Absa must repay 1.1 billion rand to the state. The bank said in court filing it had not benefited from the central bank bailout of Bancorp because the price it paid for it took into account the central bank's financial assistance. And still in South Africa, the consumer confidence has slipped deeper into negative territory in the second quarter, heightening households' concerns about the weak outlook for the economy. The Consumer Confidence Index, sponsored by First National Bank and compiled by the Bureau for Economic Research, slumped to 9 in the second quarter after registering -5 in the first 3 months of the year. South Africa sank into recession for the first time in 8 years in the first quarter, hit by weakness in consumer sectors such as wholesale, retail, and accommodation. We'll take a quick break and we'll be back in a moment. To stay with us.